Welcome to our exciting journey into the world of investing. If you've ever dreamed of building wealth and securing your financial freedom, you're in the right place. In this series, we're diving into the 6 best compounding assets that can help you grow your money over time. From the bustling stock market to the steady stream of bonds and the safety of high-yield savings accounts, we've got you covered. Imagine turning your savings into a thriving garden of wealth, where each investment is a seed that grows over time. We'll explore how you can start with just a little and turn it into a lot using the magic of compounding. Whether you're a beginner or looking to diversify your portfolio, our guide will provide you with the knowledge and strategies you need. We'll kick off with stocks and dividend stocks, where you can own a piece of your favorite companies and get paid while you sleep. Then, we'll simplify the world of index funds and mutual funds, making it easy for anyone to jump in. Don't worry, we won't forget about bonds and high-yield savings accounts, your best friends for steady growth and security. So are you ready to take control of your financial future? Join us on this adventure, and let's grow our wealth together, one smart investment at a time. Get ready to be inspired, educated, and empowered to make your money work for you. Chapter 1. Stocks, the foundation of wealth building. Investing in stocks is like becoming a small owner of a company. Imagine if you had bought shares in a tech giant like Apple or Amazon early on. Today, you'd be sitting on a gold mine. The key here is to start early. As Warren Buffett says, the stock market is designed to transfer money from the active to the patient. Stocks can seem scary with their ups and downs, but it's all about playing the long game. Over the past century, the average stock market return has been about 10% per year. It's not about timing the market, but time asterisk and asterisk the market that counts. Think of each share as a seed. Given time, those seeds can grow into a lush forest. One smart strategy is to invest in ETFs, exchange-traded funds. They're like a basket of stocks, which means you're not putting all your eggs in one basket. This diversification helps lower your risk. Plus, ETFs often come with lower fees than buying stocks individually. It's a win-win. Did you know that if you had invested $1,000 in the S&P 500 ETF 30 years ago, it could be worth over $20,000 today, assuming an average return? That's the magic of compounding in action. Chapter 2. Dividend stocks, earning while you sleep. Now let's talk about dividend stocks. These are the golden geese of the investment world. Companies that pay dividends share a part of their profits with you, the shareholder. It's like getting a thank you note with cash inside just for holding on to their stocks. Reinvesting dividends is where the real magic happens. This means using your dividend payouts to buy more shares of the stock automatically. Over time, this can significantly increase the number of shares you own, and consequently, the dividends you receive. It's a cycle of growth. Consider this. A company paying a 4% dividend yield might not sound exciting at first glance. But if you're reinvesting those dividends, your effective yield on the original investment grows over time. This is due to buying more shares, which in turn generate their own dividends. It's a beautiful snowball effect. Some of the most successful investors are big fans of dividend stocks. As John D. Rockefeller once said, "Do you know the only thing that gives me pleasure? It's to see my dividends coming in." That pleasure comes from seeing your investment grow without having to lift a finger. To wrap up, investing in stocks and dividend stocks is about being patient, consistent, and reinvesting your gains. It's not just about choosing the right stock, but also about sticking with it through the highs and lows. With time and compounding, these investments can become a significant source of wealth and financial security. Embarking on this investment journey might seem daunting, but remember, every expert was once a beginner. By focusing on these foundational assets, you're taking the first steps towards building a brighter financial future. Let's continue to explore and grow our wealth together. Chapter 3. Index funds, the simple path to diversification. Index funds have become a favorite among investors for a good reason. They track a specific market index, such as the S&P 500, providing a diversified portfolio in a single investment. This means you're essentially buying a small piece of each company in the index. The beauty of index funds lies in their simplicity and efficiency. One of the most compelling arguments for index funds is their cost effectiveness. With lower expense ratios compared to actively managed funds, more of your money stays invested and compounds over time. Vanguard founder John C. Bogle famously said, The simplest and most efficient investment strategy is to buy and hold all of the nation's publicly held businesses at very low cost. Index funds embody this philosophy perfectly. A fascinating fact about index funds is their performance. Over the long term, they tend to outperform a significant portion of actively managed funds. According to research, over a 15-year period, only a small percentage of active funds manage to outperform their benchmark index. This makes index funds an attractive option for those looking for steady, long-term growth without the hassle of picking individual stocks. Investing in an index fund is like casting a wide net. You're not betting on a single fish, but rather the productivity of the entire ocean. This reduces your risk and smoothens the ride through the market's inevitable ups and downs. It's a set-it-and-forget-it approach to investing that has proven successful for millions of investors worldwide. Chapter 4. Mutual Funds. Let the experts take the wheel. Mutual funds bring a different flavor to the investment table. They are pooled investments managed by financial experts who attempt to outperform the market. This active management means someone is always watching over your investment, making decisions to buy or sell assets within the fund. While mutual funds come with higher fees than index funds, due to the active management component, they offer the potential for higher returns. The expertise of the fund manager plays a crucial role in this. As legendary investor Peter Lynch, who ran the Magellan Fund at Fidelity Investments, demonstrated, the right manager can make all the difference, turning a mutual fund into a powerhouse of returns. A unique feature of mutual funds is their ability to specialize in various sectors or investment strategies, such as growth, income, or balanced funds. This gives investors the opportunity to tailor their investment to match their personal financial goals and risk tolerance. Whether you're interested in tech innovation, green energy, or global markets, there's likely a mutual fund that aligns with your interests. Choosing the right mutual fund requires a bit of homework. Look at the fund's performance history, but remember, past performance is not indicative of future results. Consider the fund's fees and how they impact your investment over time. A mutual fund with a consistent track record of beating its benchmark after fees can be a valuable addition to your portfolio. Chapter 5. Bonds, the steady income stream. Bonds are essentially loans you give to a corporation or government in exchange for regular interest payments. Think of them as a more predictable, less roller coaster-like investment compared to stocks. Bonds might not make you rich overnight, but they offer a steady hand to hold during the market's wild swings. One interesting aspect of bonds is their inverse relationship with interest rates. When interest rates fall, bond prices rise, and vice versa. This dynamic adds a layer of strategy to bond investing, particularly in timing purchases and sales for maximum benefit. Investing in bonds can be a calming presence in your portfolio, especially during volatile market conditions. They're like the dependable friend who's always there for you, providing a reliable source of income through their interest payments. Plus, reinvesting those payments can compound your returns over time. Governments and corporations issue various types of bonds, each with its own risk and return profile. For example, U.S. Treasury bonds are considered one of the safest investments, backed by the full faith and credit of the U.S. government. On the other hand, corporate bonds typically offer higher interest rates, reflecting the greater risk of lending to businesses. A fun fact to note: did you know that if you had invested $10,000 in 10-year U.S. Treasury bonds 20 years ago, you'd have a significantly higher sum today, all with relatively low risk? This demonstrates the power of bonds in providing a secure, compounding return on your investment. Chapter 6. High-yield savings accounts, where safety meets growth. High-yield savings accounts are the unsung heroes of the financial world. They offer a safe place to park your money while still earning a respectable return. Unlike the typical savings account that offers minimal interest, high-yield savings accounts can offer rates several times higher. These accounts are perfect for your emergency fund or saving for short-term goals. The best part? Your money is not locked in, and you can access it whenever you need it. Plus, with the power of compound interest, your savings grow faster over time. It's essential to shop around for the best rates since they can vary significantly from one financial institution to another. Online banks often offer the highest yields because they have lower overhead costs than traditional brick-and-mortar banks. Did you know that the difference between a 0.1% and a 2% interest rate on a savings account can be hundreds of dollars in interest earned over a few years? This highlights the importance of choosing the right high-yield savings account for your cash reserves. In today's digital age, opening a high-yield savings account is easier than ever. With a few clicks, you can start earning more on your savings. Remember, in the world of compounding, every little bit counts. In wrapping up, both bonds and high-yield savings accounts offer valuable strategies for building wealth. Bonds provide a steady income stream and can balance the risk in your investment portfolio. High-yield savings accounts offer a risk-free way to earn interest on your cash reserves. Together, they form the bedrock of a solid financial foundation, ensuring that your investment strategy is both balanced and diversified. As we've journeyed through these chapters, from stocks to savings accounts, the key takeaway is clear. Diversification is not just a buzzword, but a practical strategy to navigate the complexities of investing. By understanding and applying these principles, you're well on your way to financial success. Let's continue to explore, learn, and grow our wealth together, one smart investment at a time.